Welcome to the Deep Dive. Ever wish you could get, a direct look inside a major company, understand its health, and maybe even get a feel for the wider economy, straight from the source?
Well, that's exactly what we're aiming for today. We're diving into MSC Industrial Supply's fiscal Q3 2025 performance.
Yeah, we've gone through their latest earnings call, listening to the CEO, COO, CFO, head of IR, plus all those analyst questions.
It's like being a fly on the wall, really. Hearing the top leadership talk about what's critical for their business right now.
And the goal here, by the end of this, you'll get MSC's results, sure, but also hopefully some real insights into manufacturing supply chains.
And how companies actually deal with things like tariffs, shifts in customer behavior, all that strategic stuff.
Okay, let's get into it.
Right. So first up, let's just lay out the Q3 financial picture. There's some interesting progress here.
Okay, so average daily sales ADS, they were down 0.8% compared to last year. A small dip.
Right. But, and this is key, they saw a big jump within the year. ADS improved 7% just from Q2 to Q3.
7% quarter over quarter? That sounds pretty significant. More than usual.
Yeah, MSC said it exceeded their typical sequential averages, so it does suggest some kind of rebound is happening. And looking forward, June's preliminary sales trending about flat.
Okay, so maybe stabilizing after that sequential bump. Interesting. What about profitability then, with sales slightly down year over year?
That's another strong point, actually. Gross margins hit 41%. That's up 10 basis points from last year.
Even with tariffs?
Yeah.
That implies good price management, right? Or cost control.
Exactly. It signals they're managing that price-cost dynamic pretty effectively, even with that tariff inflation kicking around. And their adjusted operating margin, also up sequentially. A big jump, 190 basis points, hitting 9.0%, right where they expected.
Okay, those margin numbers are strong in this climate. And the bottom line, EPS.
Reported GAAP EPS came in at $1.02. Adjusted was $1.08.
And overall financial health, debt levels?
Pretty healthy, yeah. Net debt's around $449 million. That works out to about 1.1 times EBITDA. So, quite manageable. Shows they're generating decent cash from operations.
And speaking of cash, I saw the free cash flow conversion number look really high.
It was very strong, 134% conversion in Q3 alone, and 129% for the fiscal year so far. They're turning profits into actual cash very efficiently.
Wow. Okay. So how are they using that cash? What's the capital allocation strategy looking like?
Priority one, they said, is organic investment, putting money back into the business itself for growth, efficiency,
Makes sense.
But they're also returning cash to shareholders, about $56 million in Q3 through dividends and buybacks. That's $181 million fiscal year to date.
Okay, so balancing internal investment with shareholder returns.
Got it. So that's the financial backdrop. Let's dig into the strategies driving these numbers. What are the core initiatives?
Yeah, they really highlighted three main areas for fiscal 25. First, focusing on re-energizing the core customer.
The small to medium-sized businesses, right? Their traditional base. How's that going? Well, core customer daily sales were down 0.8% year over year, same as the overall company. But, and this is the positive spin, it was their best sequential performance. Suggests maybe they're turning a corner with that group.
And they linked that improvement to specific actions, didn't they? Like website changes?
They did, yeah. Web enhancements rolled out late Q2 seemed to be helping, making things faster, easier for customers. They saw direct traffic to the site grow low double digits year over year.
Okay.
And mid-single digits just quarter over quarter, with site conversion rates looking encouraging, too.
So the digital push is paying off there. Is it just digital or?
No, it's backed up by marketing and Salesforce changes, too. A mix of digital and, personal outreach, trying to connect better.
Right. What's a second strategic priority?
Maintaining momentum in high-touch solutions. Things like their in-plant programs and vending machines.
Ah, the more integrated stuff, where they're basically embedded in the customer's facility.
Exactly. And those are growing nicely. In-plant program count is up 23% year over year, almost 400 programs now.
Wow, 23% growth.
And vending machines, up 9%, over 28,700 machines installed.
And how much of the business is that now?
Quite significant. Each one, vending and in-plant, makes up about 19% of total company sales in Q3. And the sales through those solutions are growing well. Vending up around 8%. In-plant customer sales up 10% year over year.
Those are solid numbers. Clearly areas where they're adding value beyond just shipping a part.
Definitely. They also mentioned focusing on their OEM product line. That saw a low single-digit ADS improvement, too.
Okay, so core customer turnaround, momentum, and high touch. What's the third pillar?
Optimizing cost to serve and productivity. And this is where tariffs really come into the discussion.
Right, the elephant in the room for many industrial suppliers. How are they handling it?
Well, the COO sounded pretty confident they can mitigate the impacts. They did some surgical price increases back in March, and then a more broad-based one, low single digits, right at the end of Q3.
Okay, passing some of it on.
Yes, but what was interesting was the framing. They see tariffs almost as an opportunity to get closer to customers.
An opportunity. How so? That sounds counterintuitive.
By doubling down on helping customers find cost savings, offering alternatives, especially for products hit by tariffs, basically being a problem solver.
Oh, trying to strengthen the relationship by helping navigate the pain point. Makes sense.
And get this, their Made in USA offering, it's gaining traction. Daily sales up year over year, and it outperformed the total company sequentially.
So providing alternatives is actually working. That's smart adaptation.
Yeah. And beyond tariffs, this productivity bucket also includes network optimization, getting inventory closer to customers, improving working capital, freight efficiency.
The operational nuts and bolts. Any savings targets there?
They're aiming for $10 to $15 million in annualized savings from that by fiscal year 2026.
Okay, tangible goal.
And finally, under productivity, they mentioned leadership in tech. They brought in a new CIO, John Reichelt.
Focus on.
Operational efficiency, customer experience, systems upgrades. Specifically, that big digital core project, upgrading their main order-to-cash, procure-to-pay systems. That had slowed down, but now they're accelerating it again.
Ah, the foundational tech stuff. That sounds like a long-term play for efficiency gains beyond 26 even.
Exactly. They see major long-term productivity unlocks coming from that.
Okay, so lots of internal activity, lots of strategic initiatives. But how does this stack up against the wider economy? What's the macro picture they're seeing?
Still pretty challenging is the short answer. Manufacturing end markets remain subdued overall.
Meaning?
Most of their big sectors, like automotive, fabricated metals, they're still contracting. That lines up with the official IP index, the industrial production numbers.
Any bright spots?
Aerospace, that continues to grow. And the outlook there is still strong, but it's kind of the exception.
And what about general business mood?
Yeah.
Customer sentiment?
Yeah, they track the MBI, the Manufacturing Business Index. It actually turned positive back in March, first time in nearly 2 years, but then
Slipped back.
Slipped back negative in April and May. So reflects ongoing caution. Customers are hesitant, worried about tariffs, general uncertainty.
Did MSC see that hesitation directly in their own sales pattern?
They did.
Yeah.
Mentioned a soft April, partly because customers were trying to figure out the tariff impact, but then things apparently improved in May and June.
Okay. So despite that caution, are there initiatives maybe helping them outperform the market?
They seem to think so. They're encouraged because their performance gap against the overall IP index is improving. They're actually outperforming the index in 3 of their top 5 end markets.
So even if the tide is low, they might be navigating it better than average, gaining share, maybe?
Potentially, yeah. Or at least mitigating the downturn more effectively because of those internal efforts.
So putting all that together, the internal initiatives, the cautious macro view, what's their actual guidance for the next quarter, Q4?
Okay, for fiscal Q4, they're expecting average daily sales to be somewhere between down 0.5% and up 1.5% year over year.
Which is roughly flat compared to Q3, right?
Yeah.
At the midpoint.
Yes, exactly. So basically holding steady sequentially. That guidance includes the benefit from pricing, some early momentum from those growth plans we talked about.
But also accounts for ongoing caution, especially with tariff deadlines looming.
Precisely. They're building that caution in.
And profitability for Q4, margins.
Adjusted operating margin expected between 8.5% and 9%. And gross margin, they think it'll hold up better than the typical seasonal decline, landing around 40.9%, give or take 20 basis points.
Supported by?
Customer mix, some productivity gains kicking in. And on the expense side, adjusted operating expenses should actually drop sequentially by maybe $2 to $4 million.
Why the drop in expenses?
Lower variable costs, better productivity, less outbound freight, though offset slightly by higher medical costs, apparently.
Okay, pretty detailed Q4 outlook.
Yeah.
Did they tweak anything for the full fiscal year 25 guidance? Especially thinking about that strong cash flow.
They did. A couple of things. Depreciation and amortization, and also capital spending, both now expected at the lower end of the previous ranges.
So spending a bit less than planned.
Seems so. But the big one is free cash flow conversion. They bumped that forecast up significantly, now expecting around 120% for the full year.
Up from 100% before. That is a big jump.
Yeah, it reflects how strong that cash generation has been. It gives them a lot of flexibility, for investment, returns, whatever.
Definitely. Okay, looking even further out now, fiscal 26 and beyond, did they give any sense of the longer-term vision? Are they banking on the economy picking up or more on these internal self-help levers?
They were cautious on specific numbers that far out, understandably, but they do expect a more, let's say, normalized incremental margin picture for fiscal 26.
Meaning margins on new sales should improve.
Yeah, the idea is that operating expense growth should slow down after these last couple years of heavy investment. Combine that with the productivity initiatives really starting to bite.
And margins should leverage better.
Right. Their long-term target is still 20% or better incremental margins over a cycle. And they talked about finding latent leverage in the business.
Latent leverage, meaning unused potential.
Kind of. Potential to grow more efficiently using existing assets and operations, especially once that digital core upgrade is fully functional. They feel there's more performance to unlock internally.
Okay, so if we just sort of pull back and summarize, what are the main takeaways from this whole deep dive into MSC's Q3?
I think it shows a company really actively managing a tough environment, not just, riding the waves. They're focused strategically, getting that core customer base re-energized with digital tools and better outreach.
Right.
Pushing hard on the high-value stuff like in-plant and vending.
Or they have strong growth.
Exactly.
Yeah.
And tackling costs and tariffs head on, even trying to turn tariffs into a relationship builder. Plus, that strong cash flow really stands out. It underpins everything, showing resilience.
Yeah, it feels like less of a story about just the numbers and more about how they're achieving them. It's a good look at business adaptation, right? You see specific things, web upgrades, the Made in USA push, and how they connect to results.
Definitely. And how they're balancing price increases necessitated by inflation with trying to deliver more value and savings to customers. It's a tricky balancing act.
And that internal focus, that latent leverage idea, and the talk about a culture of continual improvement.
Yeah, that suggests an internal engine driving things, not just reacting to the outside world. A sort of self-help approach to performance.
Which brings us to maybe a final thought for you, the listener, thinking about MSC finding that latent leverage within their own operations. It makes you wonder, doesn't it, in your own work or businesses you follow, where might similar internal levers exist?
Yeah, where could significant improvements come from? Even if the overall economic conditions aren't exactly booming, what untapped potential is hiding in plain sight?
Something to chew on. We'll leave it there for this deep dive.